Hey guys, welcome back to the channel. Today we're actually talking about one of the most important metrics that you want to be looking at when it comes to valuing individual businesses, or when you're just glossing over the numbers, right? And that's return on invested capital, or ROIC for short. So today we're going to go over what it is, how it works, and why it's so important. Now, if you are new here, please do like the video and subscribe if you get any value out of the channel. I like to make a video every week or every second week, just discussing personal finance, investing, and really just trying to help you get a little bit better with your finances and hopefully get you a little closer to your financial goals. So with that being said, let's get straight into this one. So as I mentioned before, ROIC stands for return on invested capital. Now, the formula for and how to find the return on invested capital, I'll actually pop it up on the screen now for you to look at, but it's simply net operating profits after tax divided by total invested capital, or which is kind of like long-term debts plus equity. Now, I don't want to get too deep into the formula or how to calculate it, because more often than not, it's going to be done for you, and a lot of free sites will do it for you. You know, the likes of Yahoo Finance, MSN Money, Ticker, the list goes on. But most times, because it's such an important metric, it's actually already done for you. Now, if you do like to be very, very careful with your numbers, you can actually check across a couple of sites just to verify that they're all actually within either the same number or within the same ballpark. Now, what is return on invested capital? Simply put, it's just a measure of how well the business allocates its capital to maximize its profits, right? Or how well the business allocates its capital to generate profits. Now, with that formula, it's actually going to be, it's actually going to come out as a percentage, right? Once it's put, you'll find ROIC is often a percentage. For example, throughout this video, I'm going to use the lemonade stand business model, or one that I'm pretty sure we're all familiar with, just to kind of use as an example of how ROIC would apply to a business. Now, if you have a lemonade stand with an ROIC of 10%, what that means is for every dollar that you've spent on the business, buying the cups, buying the jugs, the mixers, even the sign that you put out onto the road, letting everyone know that you're selling the world's best lemonade, every dollar that you put on out of that, for every single dollar, you're getting 10 cents in profit. So if that all costs you $100 totally invested into the business, you're going to be making $10 for every $100 that you're putting in, right? Makes sense? So that's simply ROIC. Now the question is, why is it so important? Now the first thing and the first reason why it's actually really important is because return on invested capital gives you a really good peek into the management of the business. It gives you a good insight of how good that company's management or managers are at managing the company's capital, or managing the company's money. Now, and obviously you might think, how is management really that important? In fact, it's actually quite important. In fact, Warren Buffett and Charlie Munger, all the value investors, or majority of them, it's one of the key pillars they look into when it comes to analyzing a business. Because at the end of the day, the managers of the business, they're the ones that decide how your money, how your equity is going to be spent. Now, if we go back to our lemonade stand model, you're not going to put a manager that's going to be in charge of that business. You're not going to put someone in charge that's just going to waste the company's hard-earned cash, right? You're not, you don't want someone in there that, instead of making a business decision whereby, maybe investing in some new machines that'll mix up the lemonade, or more jugs so that it's more efficient and you can serve more people, therefore bringing in more money. Instead, they go ahead and decide to buy a flash new truck that they can drive around in, and their kind of reasoning for it is that they can actually, put the business name on it, and therefore advertising, right? For that business model, it doesn't really make all the sense in the world to do that. So you want someone that, operates with integrity and always has the business long-term in mind, right? The business's well-being, long-term well-being in mind, because therefore it will have its shareholders in mind. Now, the second reason why ROIC is quite important is because it's also a really good indicator that it's the business you're looking at has some form of a moat, or a long-term competitive advantage, a durable competitive advantage at that. And what I mean by that is, because when we look at this metric, we're not just going to look at 1 year's worth. We're not just going to look at our last year's ROIC. We're actually going to look at least 10 years worth of return on invested capital numbers, right? And when we look at this metric, we want a company that's, bring us return of at least 10%, double digits, right? 10% plus. If we can get 10%, that's great. If we can get more, fantastic. Not only that, we want to look over the last 10 years and see whether the business has actually either at least flat, our return on invested capital is not decreasing. What would make it a really great business is if it's actually growing, right? You see year on year, there's a trend, a clear trend showing that the business is growing its revenues, growing its returns, which means it's becoming a better business, becoming a more efficient business. Now, how this can actually show that you have a durable and competitive advantage is simply let's go back to our lemonade stand. Let's say you're obviously putting out the lemonade stand in the middle of this, on your neighborhood, and it's quite obvious that all the neighbors are coming to your stand and spending money with you, and there's cars pulling over, and it's quite just by looking at it, it looks quite busy and it looks quite lucrative. Now, obviously, you might have a neighbor that notices this and starts thinking, maybe I want a piece of the action. Maybe I should actually start. It's quite easy to start a lemonade stand. I could just start that out myself in my driveway and get a piece of that share of your share market, right? So, however, if your lemonade stand is truly a wonderful business, and if you look at a company that's growing its ROIC over time, all the investments that you've made into the company, right? Whether it be, fancy mixers, that means you can get out more product faster than your competitors, or, you've somehow invested into the best formula. You've got the ratios of water to lemon to ice to sugar just down perfect, that, you make the best lemonade in the world that keeps customers coming back. That reflects in the investments that you've made into the business, right? And if it keeps not only your current customers coming back, but attracts more customers, it shows that you're growing your returns from the money that you're putting into the business, right? So you can see that even though that competitors are trying to come into your space and trying to take your share of the market, you're not only able to maintain your customer base, but also grow it, right? So you can see how that can be a business that has some form of durable competitive advantage just by looking simply at how well they're able to make returns on their invested capital. Now, the last thing that makes return on invested capital quite important is the fact, quite simply, that a business with a high ROIC is one that's actually going to be able to compound their cash for their shareholders much quicker, right? So, for example, right, you've got your lemonade stand again. You've invested $100 into that. At the end, at 10% ROIC, at the end, you're going to get an extra $10. Now, instead of reinvesting $100, you're going to be reinvesting $110, and then you're going to get 10% on that. And as you can see, that tends to grow. 10% over a long period of time will grow and compound very, very quickly. Now, if you have a business, as you can imagine, that's not only getting you 10% year on year, but maybe even growing that, maybe 10% one year, 15% the next, and so on, you can see how that business is able to generate and produce cash and return cash to its shareholders much, much quicker than a business that is below average return on invested capital, right? So that's one of the key metrics that a lot of investors look into. I like to look at ROIC. It's one of the first things that I like to look at when you're starting to analyze a business, right? So you want that return on invested capital not only at 10% or higher, but most importantly, you want it to not be falling, all right? You don't want it diminishing. So that's, my friends, and that's everyone, is return on invested capital. Let me know down below, did you get any value out of the video? If you liked it, please like the video and subscribe to the channel. Comment down below if you have any ideas, or if you have any questions, or if there's a certain topic about finance or in investing that you want me to cover, and hopefully I can help you out with that. But guys, until the next one, I will definitely see you then. There's plenty of videos on the channel. I'll put them on the screen now. Click on them. Hopefully they bring some value to you. But until then, I'll see you guys in the next video.